You walk into a grocery store to buy your weekly essentials, right?
He's grabbing the milk, the bread.
Exactly, and you're scanning the aisles for a bargain, genuinely thinking you are participating in this free competitive market.
Right, because there's so many brands on the shelf.
Right. But what if I told you that trying to aggressively force down the price of your milk could actually directly bankrupt your own retirement fund?
I mean, that sounds completely counterintuitive.
It really does. But welcome to this custom-tailored deep dive. Today, our mission is to uncover the hidden architecture of the Australian economy.
Which is desperately needed right now.
Absolutely. We are pulling apart the structural reality of why everyday life just feels so unbelievably expensive right now. We're drawing our insights today from an analytical piece titled Big Business Grip on Australia.
It's a great piece. Really eye-opening data in there.
Yeah, it really is. And we're going to explore this genuinely wild paradox, like how a tiny handful of massive companies basically dominate almost everything you buy.
And why the most obvious solution, just breaking them all up, is actually a massive economic landmine.
It's a phenomenal puzzle, isn't it? Because the cost of living crisis, well, it seems like it should have a really straightforward, blunt force fix.
Yeah, exactly. People think, well, if prices are too high, you just regulate them down or you smash the monopolies. Problem solved.
Right. Just bring in the hammer. But the deeper you look into the structural reality of the Australian market, the more you realize that the foundations of the national economy and your personal financial future are just
They're tangled together.
tangled together in some highly complex, deeply entrenched ways.
Yeah, it's not a simple knot to untie.
Not at all. So to understand why things are so expensive right now, we first have to look at who is actually sitting on the other side of the cash register.
Who you're actually handing your money to.
Exactly. Let's look at the market concentration, because the numbers here, they redefine what dominance actually means.
They really do. It's staggering.
Right. When you do that weekly shop, you might think you have options. But Woolworths and Coles, just those two corporate entities, they make up over 65% of the entire grocery market share.
Which, I mean, when you map that out economically, it means out of every $100 spent on groceries across a country of, what, 26 million people?
26 million, yeah.
Right, so out of every $100, 65 of those flow into just two corporate bank accounts.
Just two. It's wild. And if you add Aldi into that mix.
Oh, then you are looking at over 75% of the entire industry captured by just three companies.
Scooping up over $11 billion annually.
$11 billion. And, we should probably define the terms here. When two companies dominate, like Woolies and Coles, that's a duopoly.
A duopoly, right.
Right. And when it's a small handful of companies dominating a space, like adding Aldi to make it three, economists call that an oligopoly.
An oligopoly. And what's crucial to understand is that this dominance, it isn't just about having lots of stores, is it?
No, not at all. It's about deep structural vertical integration.
Meaning they own the whole chain.
Exactly. These companies control the distribution centers, the logistics networks, and often the real estate itself.
They're actually land banking prime retail locations, aren't they?
Yes, actively land banking.
Yeah.
So potential competitors literally have nowhere to build. They just buy the lot and sit on it.
Wow. Okay, let's unpack this, because it is absolutely not just groceries.
Oh, no. It's everywhere.
Right. We are looking at an economy that seems honestly uniquely designed to stifle competition across the board.
It's systemic.
Like, look at telecommunications. Only two major telcos hold the lion's share of the infrastructure.
Right.
Look at insurance. You've got four major underwriters. You want to buy a bottle of wine. Two major retail groups control the vast majority of the liquor market.
You need to fuel up your vehicle. 4 options, powering your home. 3 major generators.
It's just inescapable.
And what's fascinating here is the sheer breadth of the consolidation. I mean, this isn't isolated to a single sector like, say, mining or airlines.
Where you'd expect massive capital barriers to entry, right?
Exactly. It is the defining characteristic of the Australian consumer experience. You are living inside a highly concentrated oligopoly everywhere you turn.
It's everywhere. I think the most jarring example of this is the illusion of choice in retail.
Oh, the department store thing.
Yes. You might decide, I'm going to be a savvy shopper today. I'm not going to Big W. I'm going to go to Kmart.
Genuinely trying to find a bargain.
Right. Or you think, actually, I'll check Target to see if they have better prices on homewares. You feel like you're making a rational, competitive choice.
You are actively shopping around, engaging in price discovery.
You aren't really discovering anything because Kmart and Target are owned by the exact same parent company.
West Farmers.
Yes, farmers, exactly. You feel like you're voting with your wallet, but the money ends up in the exact same corporate treasury.
It is a masterclass in market segmentation.
It really is.
Yeah.
They keep the branding different to capture different demographics, but they run the exact same back-end logistics.
Yep. Same supply chain, same warehouses.
So you're standing at the checkout feeling like you found a deal, completely unaware that you're just feeding the same corporate giant. It's like playing a game of Monopoly where one player starts the game already owning all the properties on the board.
That is a perfect analogy because the board is basically rigged before you even roll the dice.
Right. So now that we see the board is rigged, what does this mean for the person actually shopping, the consumer?
Well, if we connect this to the bigger picture, we have to look at the mechanical consequence of an economy running on this kind of concentrated power.
Which is what, exactly?
The fundamental economic reality is that when oligopolies solidify, competition just dies.
It just disappears.
Exactly. In a truly competitive market with, say, 10 viable grocery chains, companies have to constantly innovate.
They have to fight for you.
Right. They have to slash margins, improve store layouts, and, crucially, offer better service simply to retain your business. Because the cost of acquiring a new customer is high, so they fight to keep you.
But when you only have 2 or 3 options, that customer acquisition cost just plummets, doesn't it?
It goes through the floor.
They don't have to fight to keep you because, honestly, where else are you realistically going to go?
Exactly the point. There is zero incentive to compress their own profit margins.
And this is where we see the transition from competitive pricing to what is essentially just price gouging.
Yes. If you need the product, and we are talking about absolute essentials here like food, fuel, and electricity.
Things you literally cannot live without.
Right. The price rises simply because the market structure allows it to. There's no invisible hand keeping it down.
And it isn't just a financial drain either. It's a massive drain on your quality of life. The data in our source material shows that as these markets consolidate, service standards absolutely crater.
They fall off a cliff.
Think about your own day-to-day frustrations, right? Do the largest telcos provide fast, empathetic customer service?
Rarely. You're on hold for hours.
Exactly. Have petrol pricing cycles become increasingly disconnected from the actual cost of crude oil?
Yes.
Completely detached.
Have you ever tried to make an insurance claim and felt like you were battling a corporate fortress designed specifically to deny you?
Yes, every single time. And that is the systemic erosion of the consumer experience.
It's exhausting.
It is. You are paying a premium, receiving a baseline product, and you are expected to just tolerate poor treatment because the corporate entity knows you are a captive audience.
They know you can't leave.
They have run the math. They know that investing in better customer service yields basically no additional market share.
So they just cut that department's budget to boost dividend payouts.
Exactly. Why pay for a call center when it doesn't gain you a single new customer?
But wait, let me play devil's advocate for a second.
Yeah, go for it. Because some experts in the tech suggest this is just inevitable, a lot of economic theorists argue that this is just the endpoint of capitalism.
The natural progression of things.
Right. Capital consolidates. Companies merge to achieve economies of scale. So my question is Australia just a victim of a natural economic cycle?
Is it just gravity, basically?
Yeah. Is this just gravity doing its thing over a long enough timeline?
That is a very pervasive argument. And to be fair, in a complete regulatory vacuum, capital absolutely does tend to form monopolies.
Big fish eat the little fish.
Exactly. But society isn't a passive observer watching a boulder roll down a hill. Markets are constructed by rules.
We make the rules.
Right. We have regulatory brakes. The government has the legislative power to block mergers, enforce antitrust laws, and alter the landscape when the market actively stops serving the public good.
So it's a choice.
It is. The issue in Australia isn't that capitalism is uniquely broken. It's that those regulatory brakes just haven't been applied with enough force over the last 4 decades.
Which brings us to the elephant in the room. If the government has the options to stop these monopolies, what are they, and why haven't they used them?
Well, let's look at what's currently being discussed.
Right, because right now there is a very aggressive option floating in the political sphere. The most extreme option mentioned in our source text, recently championed by the Greens Party, is to combat high grocery prices by literally breaking the businesses apart.
Forced breakups.
Yeah. And just to be completely clear for our listeners, we are examining the mechanics of this proposal impartially. We are not endorsing the politics, just looking at the source material.
Absolutely. The mechanism they are proposing is forced divestiture.
Divestiture. What does that actually look like on the ground?
It entails the government legally compelling a massive corporate entity to sell off significant portions of its operations.
So creating smaller, independent, competing businesses.
Exactly. Taking one giant and making it 10 smaller ones.
But wait, if we break Woolworths or Coles into, I don't know, 50 little regional chains, don't we lose the immense supply chain efficiency that keeps prices from going even higher?
That is a massive concern.
Right, because it's not just a matter of saying, okay, the fruit department is now its own business and the deli splits away.
No, it's highly integrated.
You'd have to unwind massive proprietary national distribution centers and heavily integrated tech stacks.
And you've hit on the first major logistical hurdle right there. The unwinding process would be an operational nightmare.
It sounds impossible.
It would trigger an incredibly long, drawn-out legal war. These companies would utilize literal armies of corporate lawyers to fight divestiture in court for a decade.
Oh, and the taxpayer would be funding the government side of that endless litigation, right?
Exactly. Taxpayers foot the bill for the government lawyers. Plus, as you mentioned, you risk destroying the economies of scale that allow a national logistics network to even function efficiently.
But even with all those legal and operational nightmares, the text points out that still isn't the primary reason the government is paralyzed.
No, it's not.
Here's where it gets really interesting. The true resistance to breaking up these monopolies comes down to your superannuation balance.
The superannuation trap.
Yes. Unlike in America, where you might have, rich families owning big retailers.
Like the Waltons with Walmart.
Exactly. In Australia, this raises an important question about ownership. Who actually owns these massive corporate empires?
Well, they are publicly traded, and their market capitalizations are astronomical.
So it's not a single billionaire family holding the reins.
No. The vast majority of these Australian duopolies are owned either by foreign institutional investors or, critically, by Australian superannuation funds.
Which means they are fundamentally owned by the collective, mandated retirement savings of the everyday Australian workforce.
Including you, the listener.
Right. It's like finding out the termites eating your house are also the only thing holding up the roof.
That's a terrifying way to put it, but yes.
You want to exterminate them, but if you do, the ceiling collapses on your retirement. I mean, Australian law mandates superannuation contributions, which creates an enormous constant river of cash flowing into these funds.
Every single payday.
Right. And those funds need safe, domestic, dividend-paying investments to grow that money over decades.
And this is where the mechanics of monopoly power become a massive double-edged sword.
How so?
Because the very reason these duopolies can price gouge consumers is the exact same reason they generate massive, reliable dividend yields for super funds.
Oh, wow.
They have pricing power, they have huge profit margins, and they distribute those profits back to their shareholders, which, again, is you.
So it's a complete hostage situation. If we break the stranglehold these companies have on our daily expenses, we accidentally blow up our own retirement savings in the process.
Exactly. If the government actually used divestiture powers and smashed these companies apart, their stock prices would go into free fall.
The loss of their monopoly power obliterates the profit margins.
Which obliterates the dividend yield. Even just a legitimate threat of a breakup like just the government formally signaling aggressive regulatory action.
That alone would cause panic.
It would introduce massive risk into the market. Institutional investors absolutely despise regulatory risk. They would dump the stock immediately.
The valuation plummets.
Right. And because your super fund is heavily weighted in these blue chip domestic giants, your retirement balance takes an immediate devastating hit.
We are literally trapped by our own money.
It is a profound structural bind.
So, okay, if swinging an antitrust axe is just off the table because of the superannuation trap, are consumers just stuck paying half a week's wage for groceries forever?
Just waiting to retire so they can afford to eat.
Yeah. Is there no way out?
Fortunately, no. There is another path. If the blunt force approach risks a market shock, the alternative requires a surgical approach to the supply chain.
A combination of protecting small businesses and encouraging new ventures, right?
Yes. We have to look at the other side of the duopoly equation. We've talked at length about how they treat consumers, but we also have to examine how they treat suppliers.
The bullying element, the monopsony power.
Precisely. We all know a monopoly is when there's only one seller, but a monopsony is when there is effectively only one buyer.
Right.
And in Australia, the giant supermarkets act as both.
They control both ends.
They do.
Mm.
This creates a really toxic dynamic where they can ruthlessly bully small-time suppliers, particularly in the agricultural sector.
The raw data on this from the text is just infuriating. You have independent farms that are regularly forced to sell their fresh produce to the major supermarkets below their own cost of production.
Which is insane.
They are literally losing money just to get their apples or their dairy onto a shelf.
And the mechanics of why they accept those terrible terms are brutal.
Because they have literally no one else to sell to.
Exactly. If you are a farmer with a highly perishable crop, the clock is ticking. You have a very narrow window to sell before it goes bad.
Right.
When two companies control 75% of the grocery market, you either accept their below-cost offer or your entire harvest rots in the field, and you go bankrupt immediately.
They hold all the leverage.
All of it. And they weaponize it to drive wholesale prices into the ground.
But here is the real kicker, right? Do those massive wholesale savings ever make it to the sticker price you see in the aisle?
Never.
Never. They squeeze the farmer until they break, they charge the shopper a premium anyway, and they just pocket that artificially massive margin in the middle.
Which is exactly why the smartest regulatory path forward isn't necessarily taking an axe to the supermarkets at the retail level. It's heavily regulating their power at the wholesale level.
So protecting the little guy?
Yes. If you implement strict, enforceable codes of conduct that protect small suppliers from predatory pricing, you actually trigger a chain reaction that builds competition organically.
Because if a supplier is actually making a fair profit, they can accumulate capital.
Right, they can breathe.
They can invest in better equipment, expand their yield, and suddenly they have the scale to supply alternative independent markets.
Exactly. And this is a huge historical shift. 4 decades ago, an entrepreneur could realistically open a local independent supermarket and slowly grow it into a regional player.
Because the supply chain supported it back then.
Yes. Today, going up against the two giants is complete madness. The barrier to entry is a multi-billion-dollar fortress wall.
You just can't compete.
If you try to start an independent grocer today, you simply cannot source goods cheaply enough to compete with a duopoly, because the duopoly controls the entire upstream supply chain.
So what this all means for you, the listener, is that the goal is to lower that barrier to entry.
You incubate competition.
Right. Instead of taking a sledgehammer to the giants and triggering a stock market panic, the government needs to build a greenhouse to let new competitors grow safely.
You foster new brands, especially in low competition industries. You protect the suppliers, which stabilizes the wholesale market.
And maybe provide tax incentive or logistical support for new independent retail ventures.
Slowly, over a decade, you bleed the market share away from the duopolies. They go from 75% to 60% to 50%.
And crucially, because it's a gradual deflation of market dominance rather than a sudden legislative execution, the stock market doesn't panic.
Exactly. No panic.
The superannuation funds have time to rebalance their portfolios, meaning the retirement funds remain safe.
While the cost of living at the checkout slowly becomes competitive again.
It is an incredibly delicate economic needle to thread.
It is, but it is deeply necessary. The fundamental truth remains. A modern, wealthy nation of 26 million people should not have its critical infrastructure, its food supply, and its financial sector dominated by just a handful of boardrooms.
Absolutely not. It really is a wake-up call to how deeply engineered our everyday transactions actually are.
It changes how you look at shopping.
It does. So to summarize the journey we've been on today, Australia's economy is basically choked by duopolies in almost every sector, leading to high prices and poor service.
The illusion of choice.
Right. And while the urge to tear these giants apart is really strong, the superannuation trap makes it a highly dangerous game for the average Australian's retirement.
The real fix lies in protecting suppliers and incubating fresh competition.
Exactly. Neutralizing that monopsony power.
Which leaves us with a deeper, perhaps slightly uncomfortable question for you to consider the next time you are standing at the checkout.
Oh, I like this. What is it?
Well, we mentioned that a country of 26 million people shouldn't be dominated by just 2 companies per industry. But think about this the next time you tap your card to pay for overpriced essentials.
Okay.
If our mandated retirement savings are inextricably linked to the exorbitant profit margins of these corporate giants, At what point do we decide whether we are truly consumers funding our own future or just a captive audience funding theirs?
Wow. It completely changes how you look at the receipt in your hand.
It really does.
Thank you for joining us for this deep dive. Until next time, keep questioning the hidden architecture around you.